Dividend growth is one of the most important factors for the long-term dividend investor. Major companies have just announced dividend raises. Throughout this video, I'm going to share 15 dividend increases you need to know about. As an example, that will include some lower yield names like Fix, which has insane dividend growth in recent years, leading to a fantastic total return. Another example is Hess Midstream, ticker symbol HESM, which has a 7.5% dividend yield and high dividend growth. This proves you can get reliable high dividend growth from some higher yield stocks. And of course, I'll share some raises from new dividend initiators like this big tech giant Alphabet, which just announced their first dividend increase. And throughout, I will share a lot of high quality names, some of which may be new to you, so you should add it to your watch list. But first, I want to announce our official partnership with Seeking Alpha. They are the official source of dividend news for dividenddata.com. So now you can get every single dividend declared, filtered by increases, decreases, and special dividend payments. And if you're a website member, you can have those filtered by the stocks you own and have on your watch list. But the best part is, thanks to Seeking Alpha, you can now click through on these links and actually get even more detailed information about the dividend news and the increase. And as you click those links, please create a free account with Seeking Alpha so that they know that we sent you. Also, if you click the link below and sign up for our free weekly email newsletter, you can get the latest dividend news sent straight to your inbox. And our email subscribers have been enjoying that a lot. And if you're not a dividenddata.com member, we also have a free dividend news tool. I'll include a link to that in the description and pinned comment of the video. With that said, let's roll the intro and get into these dividend raises. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. So let's jump straight into the dividend raises. And by the way, I'm going to be going in the order of most recent to oldest on this list. And I did curate this so you're only getting the most notable ones that you would actually consider investing in. First, we have Lennox, ticker symbol LII, that just raised their dividend by 13%. This is payable on July 15th for shareholders on record as of June 30th. And when we head over to the stock analysis tool over on dividenddata.com, you can see that Lennox International actually has a pretty compelling history of returns. Earnings per share has grown at a very high rate coming out of the great financial crisis, and the same goes with stock price. And before we even include this latest dividend raise, as that was just off the presses as I was recording this video, what would now be the trailing annual dividend prior to this raise, the dividend yield is 0.8%. Now that is up to 0.9%. So yes, this is a low yield stock, but it is a very low payout ratio as well, with a current earnings per share payout ratio and free cash flow payout ratio below 20%. This is a quarterly dividend stock. And prior to that big increase, the 10-year compound annual growth rate of the dividend was 14.38%. And typically they do increase it on an annual basis, although they did wait nearly 2 years from 2019 to 2021. The payout ratio based on both free cash flow and net income is always in a sustainable range for this stock. If we head over to the AI analyst on dividenddata.com and you can type in any stock and dividend yield, scroll down and we can look at this dividend yield chart and you can see the yield every single day for a stock. And the main takeaway you can have here is it's always in a low yield range, but this has been as high as 2.3% in 2022. So we definitely are on the lower end of the past 5 years here. But the reason is the stock has done fantastic in terms of total return in that time. The 5-year total return is 187.7%. And since 1999, this stock has done quite well in the market with a 4,568% total return. Stock number 2 that I'm going to be sharing today is Ralph Lauren, ticker symbol RL, the top fashion brand that you may be aware of. They just raised their dividend by 10.6%. That is payable on July 11th for shareholders on record as of June 27th. If we head over to the stock analysis tool, you can see that this stock has done a little worse, and it definitely has had some ups and downs over the years. However, earnings for Ralph Lauren is hitting all-time highs, and it seems to be on a trend to long-term growth. And that's why you've seen the stock price do better lately. And Ralph Lauren does have a history of dividend growth, although it's not on a reliable annual increase basis. And they also did suspend the dividend payment in 2020, which a number of companies did during the pandemic. The 10-year compound annual growth rate of the Ralph Lauren dividend is 5.14%. And the current dividend yield prior to this latest increase is 1.19%. It's a quarterly dividend with a sustainable payout ratio based on both free cash flow and net income. The current free cash flow payout ratio is 21%, and the current EPS payout ratio is 30%. Stock number 3 that I'm going to be sharing today is Northrop Grumman, ticker symbol NOC. This is the military and defense contractor you may be familiar with if you live in the United States. They just raised their quarterly dividend payment by 12.1% to $2.31 per share. That dividend is payable on June 18th for shareholders on record as of June 2nd. If we head over to the stock analysis page for Northrop Grumman, you can see they've had pretty good growth of earnings and price over the long term, although it does seem like the earnings have plateaued over the past few years. Likewise, you've seen the stock price kind of huddle in this range. So when we zoom out to the longer term with the dividend, it's interesting to see this high of dividend growth for Northrop Grumman. In fact, this is actually a great dividend growth stock. The 10-year compound annual growth rate of the dividend is 11.19%, and the dividend yield after this latest increase is 1.95%. As you can see, they just had their 12% increase, and the one prior to that was actually 10%. And the one before that was 8%, so they're seeing an acceleration in dividend growth. Now, if we look at the payout ratio for Northrop Grumman stock, it's actually in a pretty healthy range. The free cash flow payout ratio is 45.25%, and the earnings per share payout ratio is 28.41%, and it's always in this healthy range. And if we look at the yield history for Northrop Grumman stock, it has gotten as high as 3.5% and 4% dividend yields in the past, but that was during the Great Financial Crisis. And prior to that, it wasn't that high since the dot-com bubble. Over the past 5 years, this 1.9% level is actually kind of on the higher end. And the valuation is somewhat reasonable right now because it hasn't gone up that much. The 5-year total return is 58.4%. But since 1990, this stock has been a great one to own with a total return of 13,850%. Stock number 4 I'm going to share today is Chubb, ticker symbol CB. This is an insurance company that Warren Buffett actually has been buying a little bit of their stock over the past few years. They just announced a 6.6% dividend increase, and that will be payable on July 3rd for shareholders on record as of June 13th. And this stock has done quite well long term. It's an insurance company. Warren Buffett likes insurance companies, and it does trade still at a pretty low valuation in terms of PE ratio. And earnings have been accelerating in recent years. This is a quarterly dividend payer that typically has annual dividend raises. The current dividend yield is 1.35%, but the payout ratio is super low at below 15% and below 10% with the free cash flow based payout ratio. The 10-year dividend CAGR is 4.08%, and this is getting faster with a 3-year CAGR of 6.63%. And this dividend growth is getting faster with the most recent increase at 6.59% and the one prior to that at 5.81%. And again, the payout ratio is super low for this stock, so they generate far more cash than they're paying in dividends. They have been using this for share repurchases as well in recent years. And really, since Warren Buffett started buying this stock, the price has kind of been going up a little bit. So in terms of dividend yield, it is on the lower end of the past 5 years right now. The 5-year total return for Chubb stock is 164.2%. And since 1993, it has a 5,500% total return. Stock number 6 that I'm going to share today is KLA, ticker symbol KLAC. This is a semiconductor company that focuses on manufacturing equipment and I think related software in that process as well. They just raised their quarterly dividend by 11.8%, and that is payable to shareholders on June 3rd for shareholders on record as of May 19th. So that has already passed. And as we look at the stock analysis page for KLA Corporation, this is a company that dividend growth investors have loved for a while. The stock has done very well in recent years. Earnings is at all-time highs now, and the stock price has followed that path upward. They also projected to have high earnings per share growth in the coming years, and this is a company with fast dividend growth. The 10-year compound annual growth rate of the dividend is 14.28%, and yes, this is actually getting faster. In fact, in the past year, they have had 2 dividend raises. They just had their 11.7% increase, and just 2 quarters ago, they had a 17.2% increase. So this puts the 1-year dividend growth at 31%. The current dividend yield is 0.99%, and the dividend is very sustainable with a 25% free cash flow payout ratio and 28% based on earnings per share payout ratio. And as we look at the dividend yield for KLAC, you can see it's on the lower end right now at around 1%, and this has gotten as high as 3 and even 4%, but that was during some of the bust cycles for semiconductors, and that yield has fallen in recent years as the stock price performance has improved. The 5-year total return for the stock is 360.5%, which is fantastic. And this one is crazy. If we go back to 1990, the total return for KLAC stock is 68,289%. For stock number 6, we have a little bit more of a boring one. Watts Water Technologies, ticker symbol WTS. Although it seems boring, they just raised their dividend by 21%. And the company has actually had very strong growth and earnings growth in recent years. And again, this is a sneaky high dividend growth stock. The 10-year compound annual growth rate of the dividend is 11.83%, and this is increasing over time. In fact, they are increasing at nearly 20% every single year. The most recent one, 20.9%. Prior to that, 19.4%, and prior to that, 20%. And the best part is the payout ratio is still super low. Last fiscal year, they had a 17% free cash flow payout ratio, and that's 19% based on earnings per share. So not only are they growing that dividend, but it's actually staying in that super low payout ratio range. And if we go and look at their free cash flow per share, you can see that that has been growing in recent years at a very high rate. The 3-year CAGR is 28.73%. And if we look at the dividend yield over the past 5 years, right now it's kind of in the lower end, but it really always is in this 0.5% to 1.2% range. And that makes sense given how fast the company is growing and their high dividend growth. The 5-year total return for WTS stock is 200%, but a lot of that has been in recent years, because if we go back to 1990, the total return for this stock is only 1,700%, which is actually not that good. In fact, from 1990 to 2009, the stock only had an 8% total return. That is horrible. Imagine if that was your portfolio over 30 years. But it seems like something happened in their business in recent years that has been leading to higher earnings, free cash flow, dividend growth, and ultimately the stock price has followed. So this may be an interesting one worth diving into and doing more research on why their business is doing better. And speaking of doing more research, of course, I have dividenddata.com that I built to do research on dividend stocks. But if you want even more tools for doing research, then I suggest you check out our partner for dividend news, Seeking Alpha. If you use the link in the description and pinned comment, you can get an exclusive deal from me where you get $30 off Seeking Alpha Premium. And they have a community of expert stock analysts, and this gives you access to all of their articles. And also, if you want data-driven stock picks that have actually beaten the market over the past few years, then check out their Alpha Picks product. I also have an exclusive offer where you can get $50 off Alpha Picks. The links to both of these will be in the description and pinned comment of this video. But that's enough of that because I have a lot more dividend raises to share. As an example, a new stock in my personal dividend growth stock portfolio that is both high yield and high dividend growth. That's Hess Midstream LP, ticker symbol HESM. They just raised their quarterly dividend by 1.23%. Now that may not seem like a lot, but as we dive into the stock, the picture becomes a little bit clearer. As an example, when we take a look at the dividend data, you can see that the current dividend yield is 7.47%. And you'll notice it's a quarterly dividend, but they've actually been increasing it every single payout. In fact, the dividend has been growing at a 5-year compound annual growth rate of 10.49%. So yes, they just had this 1.2% increase, but these quarterly increases have been at 2.4%, 2.5%, 2.4, 2.7, 2.7, 2.7, and it has cycled from these 1% increases back up to these 2% increases in the past. This company also has a free cash flow payout ratio of 37%, which is very low, although their earnings per share payout ratio in recent year was around 100%. But what matters more for these companies is their distributable cash flow because they're a limited partnership. So free cash flow is a slightly better metric. But the crazy thing really here is the combination of high yield and high dividend growth. If we look at the dividend yield for HESM over the past 3 years, you can see it really hovers between a 6.5% yield all the way up to a 9% dividend yield. So right now we're in a pretty healthy range around 7.5%. But if we look on a historical basis, there was one time period where this stock really was an outlier, and that was true of much of the oil and gas sector, which was in the year 2020 during the oil crash. The dividend yield for HESM got up to 21%. 21%. That is insane. That is absolutely crazy and was a historic buying opportunity. I wish I had this stock on my radar at that time. And it has fueled a great return over the past 5 years. The 5-year total return is 198.6%. And since going public in 2017, they have a 167% total return. But in those first few years, the stock was a little bit overvalued, and then they had that oil crash. I would say the past 3 years are more representative of what you could expect moving forward. The total return over the past 3 years is 53.3%. Next up, we have another top dividend growth stock that is not talked about that often, Comfort Systems, ticker symbol FIX or FIX. They just raised their dividend by 12.5%. And as we look at the stock performance for Comfort Systems USA, it really just jumps off the chart. And after looking at the financials for this one, I had to add this to my watch list, and I will be doing more research on it in the future. Well, first off, the stock price just boomed, and that is entirely backed up by very high earnings per share growth. The dividend growth for this stock is absurd. And yes, it's a low yield, only at 0.39%, but the payout ratio is still sub 10%. So the earnings and cash flow of this business far exceeds the current dividend. And if you look at their dividend growth, you'd see a 22.3% 10-year compound annual growth rate. And normally that would be very high, but it's actually gotten faster and faster and faster. In fact, they're now doing multiple dividend increases a year, and they just had 3 dividend increases back to back to back at 12.5%, 14.2%, and 16.67%. And that puts the 1-year dividend growth rate at 50%. 50% dividend growth. And despite that, the payout ratio is getting lower. We are at a 5.7% free cash flow payout ratio and an 8% earnings per share payout ratio. And you can see that the free cash flow has just exploded at this business. If you don't already have this on your watch list, click add to watch list and make sure it's there. So as we look at the historic dividend yield for this stock, you can see it's just gone down and down and down, but that's because the price has soared so much to reflect the increasing earning power and growth. And actually, based on the past 3 years, the dividend yield's kind of in the middle right now. And over the past 1 year, it's on the higher end. The 5-year total return for fixed stock is 1,182%. Absolutely insane. The 3-year total return is 435%. And this is another interesting one where all of the high returns is in recent years for the company. If you invest in the stock in 1997, you would have had a negative 5% total return by 2013. But now in 2025, the total return is 3,585%. But so much of that growth was just in the past few years. And this is a business where it seems like they figured something out, and even if they just grow slower than they did in recent years, in the years coming, there's going to be a lot of returns for investors. Next up, we have another one of my top stocks, Alphabet, ticker symbol GOOGL or GOOG. This is the parent company of Google. They are a new dividend initiator, but they just had their first dividend raise on their quarterly dividend, and that was a 5% dividend increase. I'm not going to talk a lot about this company because I cover it all the time on the channel. I've made a bunch of videos in recent months, but it's one of the best businesses in the world. Their earnings are growing very fast, and it trades at a reasonable valuation with expectations of high earnings per share growth in the coming years. They are one of the leaders in AI, and if you watch their latest I.O. event, which was insane, the pace of innovation in AI is really mind-blowing. Alphabet has one of the best balance sheets in the world and very high free cash flow and operating cash flow. And they are finally starting to return some of that to shareholders via a dividend payment. It is still very small at below a 10% payout ratio. The current dividend yield is 0.49%. And the most recent dividend increase of 5% is small, but over the long term, I do think this stock is set up very well in terms of total return. On top of dividends, they have also been repurchasing shares in recent years, and this continues at a very high rate. So I feel very comfortable with Alphabet as one of my core positions in my long-term dividend growth stock portfolio. Next up, we have Equifax, ticker symbol EFX. They just increased their dividend by 28% and issued a $3 billion stock buyback. I don't own this stock and haven't done a ton of research on it, but on the surface level, it seems like they trade at a pretty high valuation and growth has been slowing in recent years. But if we look at analyst estimates for future earnings growth, it seems like in 2026, 2027, and 2028, they're expected to have very high earnings growth in the 20 to 30% range. And I would say this latest 28% dividend increase is definitely a signal of that. The board definitely feels very confident about the future growth over at Equifax. Is it Equifax or Equifax? Let me know in the comments. The forward-looking annual dividend is $2 per share, and the dividend yield is 0.76%. The payout ratio is low, below 30%. However, this has not really been a dividend growth stock in recent years. In fact, they haven't raised that quarterly dividend since 2017. That gives it a 10-year CAGR of 5.6%. The company also has a history of dividend cuts in the past, both in 1987 and in 2001. So if you're purely an income-focused investor, you might not want to be investing in this stock, but that is a huge dividend raise that I should share. and this may have good long-term prospects in terms of total return. Next up, we have Costco, ticker symbol COST. They just raised their dividend payment by 12%. Now, Costco is one of the best businesses in the world, and you can think of them as a retail company with their wholesale clubs and everything. It's a very high revenue but low margin business, and that's not actually where the bulk of their profits are made. So you think retail and you're like, the stock trades at nearly a 60p ratio. That's insane. But you really have to rethink how you think about Costco, because it's actually a subscription membership business. That is the main profit driver of the company. And they have an extremely dominant business model, and they're able to open more and more warehouses. And as they continue to expand, they will get more and more memberships. And that's why you see this reliable growing revenue and earnings per share. This is actually a subscription company, and it is priced extremely cheap, that annual membership for Costco. And they like to keep it cheap. But theoretically, if they ever had to raise prices, the earnings capacity of Costco could be far greater than it actually is today. So that gives you a little bit of context of why it trades at such a high multiple. But because of that, the dividend yield is 0.51%. But what's nice about Costco is they have a base quarterly dividend payment, and that dividend has grown at a 12.5% 10-year compound annual growth rate. That's in line with their most recent increase of 12%. But the nice thing about Costco is that they have these large special dividend payments every once in a while. And that's because they generate more cash than they're able to actually reinvest in their business. So every once in a while, when they get a big cash cushion, they do these large special dividends. The most recent one was $15 per share in December 2023. And that's why historically, when we look at their dividend yield, you can see it kind of booms up. But that's because of the special dividend inflating it. And this also messes up the payout ratio calculation for this stock. The special dividends really mess with it. But in terms of the base quarterly dividend payment, which is the actual reality of the business, the payout ratio is extremely sustainable. The 5-year total return for Costco stock is 262%. And since 1993, the stock has a total return of 15,486%. And this shows how a simple business model with a dominant position can deliver fantastic returns in the stock market. Next up, we have Johnson & Johnson, ticker symbol JNJ. They just raised their quarterly dividend 4.8% to $1.30. This is one of those old reliable stocks in the market. It is a dividend king, meaning they have over 50 years of consecutive annual dividend increases. This is one of the higher yield stocks that I'm sharing today. Their current dividend yield is 3.41%. You could consider this a blue chip company. They've been through quite a bit of turmoil in the past few years, and their earnings have plateaued a little bit and the stock price has fallen, but they trade at a reasonable valuation, and expectations are a lot of that's in the rearview mirror, and they'll slowly grow from here. And when we look at the dividend data for Johnson & Johnson, it's a beautiful chart. Just increase after increase after increase year after year. The 10-year compound annual growth rate of the dividend is 5.65%, 3-year CAGR is 4.78%, and the payout ratio is sustainable as well. The free cash flow payout ratio is actually around 60%, and it's always in a very sustainable range. That net income payout ratio in the recent year was around 84% on the higher end. That was likely due to some GAAP accounting stuff, because in the year prior to that, it was 33%. And in general, it's always very sustainable. So I would expect continued dividend growth for Johnson & Johnson in the foreseeable future. And let's go take a look at the dividend yield for Johnson & Johnson. You can see this 3.4% dividend yield is actually one of the higher starting yields you could have gotten really in the last 30 years for the stock. Especially over the past 5 years, this is definitely on the high end. So for the income-focused investor who wants a reliable, rock-solid stock for retirement, this could be a good entry point for Johnson & Johnson. But again, as I mentioned, they've been going through a little bit of a rough patch. The 5-year total return is 20.6%. But even with that, they've done very well over the long term since 1990, 4,500% total return. Next up, we have Aon, ticker symbol AON. They just increased their dividend by 10%. And I found this company as I was preparing for the video, and I actually think they're pretty interesting, and I've never heard of them before. As you can see, the stock price and earnings per share growth has been very good. And this is a dividend growth stock, especially in recent decades, although they have had dividend cuts back in 2002. But it doesn't seem like that's happening soon because their dividend growth is very high and their payout ratio is super low. The dividend yield is 0.84%. The 10-year compound annual growth rate of the dividend is 9.5%. Payout ratio is below 20%. And it's typically always in the sustainable range based on both free cash flow and net income. And then as the penultimate stock, meaning second to last, I have Procter Gamble, ticker symbol PG. They just raised their quarterly dividend by 5%. And similar to Johnson & Johnson, this is a dividend king, meaning they have over 50 consecutive years of annual dividend increases. The current dividend yield is 2.56%. And overall, this is a reliable stock with slow earnings growth, slower dividend growth, but a decent total return, as we'll get to. The 10-year compound annual growth rate of the dividend is 4.77%. And as I mentioned, they increase this every single year. The payout ratio is sustainable with a 56% free cash flow payout ratio and 62% based on earnings per share. They've also been repurchasing shares in recent years. Now, the problem with Procter Gamble is one that you'll also see in something like Coca-Cola, where it's such a high-quality business that they really don't trade at that attractive of a valuation a lot of the time. It's pretty slow dividend growth for a 2.5% dividend yield, and it's always in this 2 to maybe you can get it at 4% dividend yield, but it hasn't been that high since 2018. And over the past 5 years, the stock has never had a dividend yield above 3%. The 5-year total return for Procter & Gamble stock is 66%, but since 1990, it's been a reliable compounder with a 4,370% total return. And finally, last but not least, we have another big tech company, which is a new dividend initiator that just had their first dividend raise. That's Salesforce, ticker symbol CRM. They just raised their dividend by 5%. This is another stock I have in my personal dividend growth stock portfolio. And the reason why is this company just prints money and it's reliable subscription revenue for the most part. Their earnings per share growth is insane. Revenue is growing at a 16% 10-year compound annual growth rate. The company is also a free cash flow machine with a 26.7% 10-year compound annual growth rate of free cash flow per share. And that has actually been accelerating. It's for that reason that the company is able to issue this new dividend payment, and I think over the long term will be a dividend growth stock. Oh, and it might have actually been a 4% dividend increase, not 5%, so I'll have to look into that one. But anyway, current dividend yield 0.59%. It's very sustainable. It's 12% free cash flow payout ratio, 24% based on earnings per share, and the company is expected to have double-digit earnings per share growth in the coming years. So the one thing I know about Salesforce is they will be generating a lot of cash in the years to come. So I think it's likely they'll become a dividend growth stock and their total return will be pretty strong. All right, so those are 15 dividend increases over the past month or so that you need to know about. I curated the most interesting ones to share. And if you want to track your own dividend news, head over to dividenddata.com, where you can get that news filtered by the stocks you own and have on your watch list. And of course, you can use all of the stock analysis tools I showed throughout the video and sign up for our free email newsletter so that you can get the latest dividend increases straight to your inbox every Monday morning. So with that said, thank you for watching, and I'll see you in the next video. Peace.